Happy investing in Tata Large Mid-Cap Fund. This is one fund where you have the choice of sectors.
One can pick and choose and do bottom-up stock picking and do a better job in identifying some mid-caps. Having said this, from an incremental perspective, and you did mention 26-27 as well.
The conviction is great.
So in today's market, I think a part of large cap also has a value and can get re-rated.
This is a great insight that mid-caps of today maybe are not the same as mid-caps some years ago that we were thinking. And hi everyone, I'm Shaily Gang. I lead the products desk at Tata Mutual Fund. And in this podcast, we'll speak about Tata Large Mid-Cap Fund, its DNA, its unique features, and the unique style of the fund manager, Mr. Chandraprakash Padiyar. He is someone who looks at calendar year 26 and calendar year 27 returns as well, and not just being sensitive about the next 6 months return. So let's discuss with him about this fund quite in detail. Hi CP, how are you?
Hi, good, Kelly.
So this fund, Tata Large and Mid-Cap, the category itself, it has a mandate to have 35% each in large caps as well as mid caps. And both these spaces are different from each other. Large caps have a good information flow. Large weights can be taken in large cap stocks, and the universe is smaller as compared to mid caps, where liquidity is one of the important considerations, and growth rates in mid caps can be far higher than large caps. So how do you look with this mandate in place, 35% each in large cap and mid cap, and with the spaces that they are, how do you navigate this category in various market phases?
So slightly different perspective that I have is that I think both large cap and mid cap, first of all, from a definition perspective, a mid cap starts the 250th company today as per the December framework from AMFI. The mid cap starts from something like 33,000 megawatt, 33,000 crore market cap. So anything above 33,000 crore up to 1 lakh crore of market cap is mid cap. And companies above 1 lakh crore, the top 100 companies, classify as large caps. From a thought perspective, when you look at these businesses, these are typically all large businesses in India. Top 250 companies listed in India are large cap and mid cap. And as you rightly said, in this fund, we look at minimum 35% allocation to large caps and minimum 35% to mid caps. I would say liquidity across large cap and mid cap is fairly strong. So there is no issue of liquidity in terms of buying and selling across large caps and mid caps. There is a difference in profile of businesses. In the large cap segment, you have all kinds of businesses, but a large part of large cap would be financials, followed by oil and gas, followed by commodities. And then there is IT and consumer. So there's a larger part of large cap universe. Whereas in mid cap, you find varied sectors. So there are more like 18 plus sectors to choose from in the mid cap segment. So you get more variety, though the number of stocks are only 150 to choose from. But in terms of sectoral variety, you get lots of it. So in terms of growth profile, if you differentiate, different cycles will give you different growth profile for large caps and mid caps. For example, last few years, financials, oil and gas, commodities are sectors where growth is slow. And even IT, for example, growth has been slow. And hence you would say that large caps are growing slower. On the other hand, mid caps are within mid cap you will have consumer, which is not growing so fast, but you will have let's say fintech companies or platform companies, so to say. They are growing very fast. So all kinds of businesses, since there are more variety available in mid caps, you can pick and choose high growth companies, and you can try and build your portfolio basis growth over a period of time. So in a way, I would agree with you. Since there is more choice, And since there are more sectors available to choose from in the mid-cap segment, one can pick and choose and do bottom-up stock picking and do a better job in identifying some mid-caps. Having said this, from an incremental perspective, and you did mention 26, 27 as well in the opening remarks, and I would say that from a next couple of years perspective, my sense is that large cap earning growth is likely to pick up and mid cap earning growth is likely to slightly moderate from where it is today, which means that even large cap from a next couple of years perspective will make sense. And some of the large caps that we look at, we are identifying or that we've identified, I think interestingly even large caps will grow at, some of them, not all, can grow at 20% plus on earnings on a CAGR next couple of years perspective. So there are opportunities in the large cap space as well as we speak, especially when valuations are where they are.
So this is a great insight that mid-caps of today maybe are not the same as mid-caps some years ago that we were thinking, and growth rates themselves are converging between large caps and mid-caps, and also the the profile or is not just related to the size. It's also about the kind of sectors which each of this space carries. So you mentioned bottom-up portfolio. Yes, that's your style, and we witnessed this and that in the performance, good performance of the funds you manage. Another part of your style is lean portfolio, which is not beyond 45 to 60 stocks portfolio. And we've seen, some funds, peer funds who have actually converged into, from 150 stocks have converged to smaller number of stocks, and they've at some point in time also diverged into a large number of stocks. So how would you, view this lane changing thing which is there in the category?
Sure. So you need to see how markets have behaved. In 2023 and 2024 specifically, for example, you've seen across, let me step back. 2021 onwards, for back-to-back for the last 4 years, every year, there has been a broad-based high earning growth. Large cap, mid cap, small cap, the smaller you are, even better earning growth. Because 2018-19, or let's say between 2009 and 2020, for a very long time in India, the corporate world went through a period of consolidation in earnings. So for example, corporate profit to GDP in 2008 was something like 6.7, 6.8%. In 2018-19, this number was less than 1.7%. So basically it told you that GDP grew, but corporate profit did not grow as much, and hence percentage to GDP it went down materially. This number 1.7 has now gone to 4.5, close to 4.5. So in the last 4 years, every year we have seen very high profit growth across the board. Large cap, mid cap, small cap. The smaller you are, the better actually. When you have this kind of an environment where everything is growing very fast, naturally you would see re-rating of valuations. And you would see a very broad-based market rally. So the last 4 years have been this kind of framework, and especially 2023 and 24. I think mid-cap segment is one of that segment in the market where a very large pool of capital was trying to invest in that part of the market, and there are 150 stocks. So you've seen a very large, let's say, pickup in performance of that segment. And valuations, in my mind, went to above normal levels in 2023-24. In that environment where everything is going up, a fund which has more number of stocks will do better than a fund which has less number of stocks. It is so clear actually when you do an analysis of performance. So in that sense, what you mentioned is very true, is that there are some fund managers who've done very well by having very diversified portfolios, 100, 150, 200 stocks in their portfolio. They've captured the momentum in the market extremely well. Having said this doesn't last long. So a momentum in the market ultimately depends on earning growth and positive surprise on earning growth. In our opinion, we've already entered that phase, and we've been saying this for 6 months now, or more than 6 months, that we have reached a phase where incrementally earning growth or surprise in earning growth, positive surprise in earning growth will be very limited nature. So we think that incrementally skewness in the market has to increase, or it will become very skewed market where some stocks will keep getting re-rated, whereas some stocks will de-rate also. And some stocks will be mediocre performance depending on their earning growth. So our belief is that we've already entered that phase where momentum will die down, which means that stock selection comes back to the picture, which is good for us because we are growth at reasonable price investment philosophy, totally bottoms up, identifying management teams, companies which can scale over a period of time consistently or with good cash flows, good profits, and available at a reasonable price, so that if these companies do better on earnings over a period of time, then re-rating happens. So with that philosophy, we run this fund, Tata Large Mid-Cap Fund, and I think good times are here for us. So we should see when stock selection does well, our stock selection should help us perform.
True. I think then we are back to the outperformance of the stocks on which you are overweight. The excess return which comes through those would be a taller bar than the negative return which would come from what you skipped.
Yes.
So I think that's the phase we've already entered in, and we are seeing that with banks already doing good in the last 1 week or so. How do you define early buying? Does early buying apply to Tata Large Mid-Cap Fund as well, as we understood it very well in Tata Small Cap Fund, but does it apply here as well in this fund?
Very much so. For example, 2024, early part of 2024, let's say between Jan and April, May, in Tata Large Mid-Cap Fund, we would have changed approximately 45% of the portfolio. Some existing stocks we added materially, or some new stocks we added, some existing stock with profits. So in nutshell, we would have, let's say, created a new portfolio with close to 45% of portfolio as new. And that was necessitated, in our opinion, because of the rally that we saw in 2023. We thought that it makes sense to change the portfolio. Now here, to answer your question, we think we are early. And the reason why I say this is that we think for most of those, not only those 45 that we changed, but the whole portfolio that we run, a large part of this portfolio from an earnings perspective in terms of positive surprise to the market should either start coming from Q4 of FY25, which is the current year, which is the period that we are in right now, Jan to March quarter, or a large part actually from Q1 FY26. And mind you, we started buying in Jan, April 2024. So in that sense, we are almost like 1 year early. When you are bottom-up stock picker and you are trying to buy for 3, 4, 5 years, then typically we as investors, we should not bother about what happens in the next 3 months, 4 months. We are buying businesses and buying for large wealth creation. When we create this portfolio, we think that way. Instead of thinking very short term, we are thinking more like the next 3, 4 years, can we create large value for investors? But I think we've reached that point where some of our companies are already starting to report good numbers in Q3 FY25. But more or less, we think the market will appreciate what we've bought somewhere around Q1 or FY26. So over a period of time, it compensates fully for all the pain that you have to bear during the waiting time. For example, typically we would, as I keep saying, we buy with a 1:3 risk reward. So if you buy early, you're buying obviously at a price at which we think downsides are very limited and upsides can be pretty handsome. But you need to have patience. And as and when earnings comes, then the re-rating happens very quickly actually sometimes. So I think the risk reward is quite positive in our opinion. And as and when these earnings get delivered, we believe market should appreciate what you've done.
I think the power of your conviction comes out very clearly, when we look at data, let's say the recent data of top 10 stocks by weight, and then top 10 contributors and where you are buying. So bottom and top contributors and where you are buying. So if the conviction is great, I think the top 10 stocks by weight, even if they feature in currently the top 10 bottom contributors, but there is conviction, additions have been made in the last 1 year, and I think that's where conviction comes out. So I'm sure this conviction gives the investors a lot of confidence.
And additionally, you would notice not only this year, last 1 year, but last 6 years since I've been managing this fund, you would notice that the average churn has been less than 0.1 every year.
Yes.
So it is not only this year's conviction that we are trying to highlight, but our long-term track record also tells you that our discipline with it, research and identifying businesses and ultimately delivery from those businesses have happened.
Yes.
It takes time, sometimes longer, sometimes shorter, and we should see better performance for this fund continuing in the next few years.
So in case of this fund also, how does the allocation towards re-rating stocks and compounders or stable earnings stocks look like, and does that change with the market phases?
Certainly, so good question. Actually, for example, 2023 and 24 again, given that that was a phase where markets were doing extremely well, I would say that especially mid-caps, valuations had, as I said, had gone above normal levels, which forced us to change the portfolio. Because the right question that you asked, we always like to be a 50-50 mix of the portfolio, which is 50% in re-rating candidates and 50% in compounding stories, which are well-known, good quality businesses, growing earnings, but valuations, there may not be room for valuation re-rating. But the 50% of re-rating candidates, we want to be early investors where earnings is likely to surprise on the positive side and they can scale those businesses, and over a period of time, market re-rates those businesses. So that's the mix that we ideally want to have. In 23-24, or let's say a part of full year 23 and part of 24, because in 24 we changed the portfolio, we had this ideal mix of 50% went down to below or more close to 35%. And we started becoming very uncomfortable with our incremental return performance perspective. So ideally we want to have a good mix of 50-50, and whenever markets go up significantly, some of our stocks also get re-rated. And that makes us review our portfolio and try and look out for new names so that we can rebuild that re-rating candidates towards 50%. So the good news today is that 2024, when we changed the portfolio, we went back to somewhere around 45%. So we didn't even, given that the whole mid-cap got re-rated, going back to 50% looked challenging to us even in the full part of 2024. But as we stand today, given that markets have corrected, given that some of the mid-caps have also corrected, this is giving us a great opportunity to go back to 50% or higher. So as we speak, we are actually higher than 50% in terms of our re-rating candidate portfolio. Given our outlook today, we are more optimistic on Tata Large and Mid-Cap performance, especially when stock selection in the market itself will start getting re-rate, or let's say you will get valuations for identifying good stocks in the portfolio. That's a market behavior which will happen, or which is already happening. But the other is the quality of businesses that or the mix of the portfolio that we've been able to create with more than 50% re-rating candidates. I think that makes us optimistic that the next few years should hold us very well in this fund in terms of performance.
And that's a great talk on the mix of re-rating and stable earnings. But alongside, you also need to you have to manage the market cap mix. So I think the large cap has been stable at around about 40%, at least for the last
44 is what the number is today. And we are at around 35-36% in mid cap. So we are at bare minimum that we need to be in mid
caps.
And we do have something like 15 to 17% in small caps and some cash. So that's the current allocation. And though mid caps have corrected, the reason why we are still at 35 odd percent, so there at the bare minimum of mid caps, is because interestingly, and the question that you first asked on identifying stock selection in large caps, we think we have a fairly good mix of large caps today in our portfolio, where we are expecting some re-rating of valuations over a period of time. So we think you can do stock selection in large caps also, where you can get great value today. So in today's market, I think a part of large cap also has a value and can get re-rated. And we've identified a good mix of mid caps where we see re-rating, and obviously small caps where we see some re-rating. So it's a good mix of portfolio, well balanced with large, mid and small everywhere.
Thank you, CP. This was a very insightful discussion. Happy investing in Tata Large and Mid-Cap Fund. This is one fund where you have the choice of sectors in mid-caps. You have re-rating options and opportunities in the large cap space as well. You have a fund manager who's very nimble, depending on the market phase, with the exposure towards re-rating candidates and stable earnings stocks. And you have a portfolio which has about 40-45% large caps, 35% mid caps, which is by mandate, and a sprinkling of good 14-15% small caps as well, and some cash to give stability to the portfolio. So thank you and happy investing in Tata Large and Mid-Cap Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.